What's going on, guys? Jonathan Chrisler coming at you with market manipulation. This will probably be broken down into a few videos because there's a lot I'm about to go over. So some of the things we can go over, they're going to sound like conspiracy theories. There's going to be things that you probably didn't learn about in school. In fact, pretty much everything I teach you probably didn't hear in school because schools don't teach you how to make money. They teach you how to be an employee. So I'm going to get straight into it. First thing you need to know about market manipulation is that banks, institutions, entities with a lot of money can manipulate price. They can manipulate price of certain currencies, certain commodities, and soon, I think cryptos, in fact, that's probably already going on. So first thing you need to know is that it costs 10,000 lots to move the market 1 pip. So if you don't know how much 10,000 lots is, it's about $1 billion. So if you wanted to move price up or down by 1 pip, you would need at least $1 billion to do that. Now, if you only had $1 billion, that would not be a good idea. So that just puts into perspective how much money these entities, the banks, the institutions have to play with. However, there are a few things market makers can't do, thankfully. The IMF, International Monetary Fund, restricts their ability to move price to a general range to avoid a collapse of the market. So we're safe from, a crash caused by this, although we're not safe from crashes caused by other things. This is generally limited to the ADR, or average daily range, and will involve moves up to 200 pips per day in most pairs. So that's just how you can measure it. In fact, if you go on charts and do some back testing on this, you'll see that currency pairs don't move more than 200 pips per day, even with the worst manipulation conditions. They do not have unlimited equity, so it is necessary for the market makers to close positions and regain balance periodically. So they do not have unlimited money. They're not playing on God mode. They can't just print it out, although some countries can. They need to pull their money back out just like us. They're in it to make money too. Same reason you're in it, same reason why I'm in it, same reason why everyone watching this video is in it. They're here to make money. So they just play it on a completely different scale than we do. The only tools they have are to buy or be able to buy or sell a currency in different volumes at different prices. So basically what that means is they don't go through a broker like Oanda or GFX or Hugo like we do. They get it as close to the source as they can. So they're essentially buying it wholesale. So they're going to Costco of the brokers. They go to Sam's Club. They're buying a big pallet full of these currencies, and we only usually buy a family-size serving. By doing this strategically, they can do the following. They can entice traders to take positions by providing evidence that price is or is going to move in a certain direction. Appeal to the emotional side of traders by changing the character and speed of price changes. Once the trap has been set and the bait taken, price moves in such a way to cause price to move against the traders, allowing the banks to buy currency back from or sell currency back to the traders so that they are square. So in a nutshell, they can change how fast price is moving, making it more emotional conditions, enticing people to go in now, trying to make that quick scalp, trying to do that quick $100, making it so they're not thinking logically. And that's what they're saying by the emotional side of the traders. They will make a small spike, sometimes even a large spike, and that's what they mean by providing evidence that price is going to move a certain direction, and that speed is getting to the emotional side of traders. And then the third note I put down is they're setting up a trap. Once people have taken the bait, that's when they pull the old switcheroo. Now the consumers or the retail traders like us are screwed over and the banks win. Now, after what I teach you through this series, you'll be able to recognize it, and you'll be able to avoid those certain circumstances most of the time. This means that the trader has entered the market by buying currency from the bank at a given price and exited the market by selling back to the bank at a lower price. Conversely, the bank has sold to the trader at the higher given price and bought back from the trader at the lower end. So that's basically just what's going on behind the scenes. We're handing the bank's money. They hand it back at a worse rate. We lost, they won. That's how they make the money, and that's their motivation for doing it. In addition to move price, market makers can take advantage of sentiment, which developed as a result of news releases of varying types. Sometimes immediate price movements are designed and used to cover up the market maker. It is not uncommon to see the general news being particularly pessimistic, for example, about particular currency, only see the currency rise against it, but usually after people have been trapped in line with the sentiment. So basically, let's say we see a giant uptrend, we see a boom, a candlestick shoot straight up, the sentiment is now bullish. But then we enter in a buy and suddenly price is going down. It's actually a bearish market. So what tools do these dealers and brokers have? Requoting, triggering all stops in a given price range, varying the speed, which is why most scalping methods often fail and why I'm actually a huge fan of swing trading, throw a price spike to take stops out, target traders who are in margin trouble and move price against their positions to finish them off. So let me just reiterate this last one. The brokers can see if you're in margin trouble. That means that you're over leveraging or you're just in a really, really bad trade and you're about to blow your account. They can see that and they will target you out and actually manipulate price against you to finish off your account so that they get more money from the transaction. All right, so that's it for the first section. In the next video, I'm gonna go over the anatomy of the M and W formation and a few other things along with market manipulation. I'll see you there.